Hello, Alexander, back once again. We finished 201, we finished 202, we finished cost accounting. You have a great foundation now. There's the three main classes that you'll take at any junior college before you transfer to a university. Sorry I haven't been back so recently. I've just been busy with school myself. And now it's summer of 2016, and I was thinking what class to do next, which was difficult to decide, and I decided to go we're going to do intermediate, because might as well keep going on the financial accounting, and this is a little bit more deeper into the rabbit hole. And so this is stuff that you can take at a junior college. That's what I did. I did the upside down degree, went to Evergreen, and so you might be able to do that sometimes, but otherwise you're going to learn this at a university, most likely. And it's just pretty much what you've already learned, but now you're going to be embellishing on it. So it's going to be a lot more detailed stuff you maybe passed over. Now we're going to go a little bit more into it, and it's great stuff. And the book we're going to be using is Intermediate Accounting by the Stice Boys. My teacher likes to call them Stice and Stice. And great book. It is has a lot of information. You can see the thickness of this thing. You won't need all of it in there. The one thing the Stice Boys do is they're very talky. They like to talk and put a lot of info in that you don't always need, but it's good to have. And so we're gonna just use this book, and chapter 1's it's just pretty much review. So I'm not gonna do any examples on the board or anything. I was thinking about it, and it's just going to be a lot of words, just almost history. It's going to be a lot of history. So I'm just going to go over it real quickly of what it is, chapter 1. And I think we're going to be doing chapters 1 through 11. 6 we didn't do in class. In my class we didn't do 6. It's all about ethics. I could do that, but it's going to be a talky one, just history too of people who've done bad. Of course, it's ethics. Arthur Anderson again, but just to think 1, 2, 3, 4, 5, 7, 8, 9, 10, 11. I think that's all we end up doing. And so, but the first one is just, of course, accounting it's vital in today's business environment. It's a service. There's internal users, external users. Internal is management. External is going to be like banks, investors. The three major financial statements you all should know from doing the other videos. Balance sheet, income statement, and statement of cash flows. And then, of course, there's auditors who work independently, externally. Usually, most likely, external auditors who work for CPAs, who will come in, check out your stuff, make sure it's all good, give you an opinion. And so it's now we're going to do a whole class on auditing, so we don't have to get too much into that. But of course, there's audited opinions, unqualified with explanation, qualified, no opinion, adverse. So it gets, it starts at the best opinion you can get down to the worst. And they just tell you what they believe, the statements, if they're good or not. The history, the U.S. accounting standard setting bodies. It all started with the Committee on Accounting Procedures, CAP. They were born in 1939, died in 1959. They were succeeded by Accounting Principles Board, APB, born 1959, died 1973. And they were preceded by a Financial Accounting Standards Board, which you all know today, FASB, born 1973 and still going today. And these are the boards that set the rules of accounting. So they're very important. Of course, the Securities and Exchange Committee was created after the stock market crash to help make sure that doesn't happen again. We have an Emergent Issues Task Force, EITF. They are just kind of like the SWAT team for the FASB, to help just if there's like an issue with accounting, they can go in quick and try to make a solution. Really interesting. I didn't know that existed. Then there's the American Institute of Certified Public Accountants, which some people belong to. American Accounting Association, which is for teachers or for professors of accounting. You might have a teacher that belongs to that. Internal Revenue Service. So tax accounting and financial accounting are very different. And the Supreme Court stated in this little phrase right here, the primary goal of financial accounting is to provide useful information to management, shareholders, creditors, and others properly interested. The major responsibility of the accountant is to protect these parties from being misled, whereas the primary goal of the income tax system, in contrast, is the equitable collection of revenue. So in tax accounting, all you care about is how much do I owe and how much do I pay. In financial accounting, is this accurate? Is this really what I'm reading? Because sometimes financial statements, it's very easy to misdo them. It's very simple. So don't, and once again, always exercise skepticism, professional skepticism. Don't believe everything you read or hear, but don't be cynical about it either. But just take everything with a grain of salt and always try to be neutral. Always want to get more. Request more information. And don't ever lean one way or the other way too heavily. That's when I think of accounting, I think of that, neutral. And so GAAP is generally accepted accounting principles. A lot of companies don't use these as much anymore. They bend the rules now, of course, because they need to show better revenue, and GAAP doesn't always fit every company perfectly. Some companies look better under a different light, this way or that way. So this is real world coming in. Of course, you want to present yourself in the best way. So GAAP may not always do that for you. And so, yeah, it's sort of funny. It was a Wall Street Journal article on that. And you have to look that up if you want to read more into it. Just type in GAAP and the Wall Street Journal. If you have a subscription on the internet, you should get that. Of course, objectives of financial reporting. It should be useful. So usefulness, understandability, target audience, investors and creditors, accessing future cash flows, evaluating economic resources, and primary focus on earning. Those are the 5 objectives of financial reporting. Usefulness, just make sure that it's useful to investors and creditors. It's make sure it's not totally off the field. Like, oh, the carpet's green. It doesn't matter. It needs to be useful. Understandability. Financial reports should be simple, and so that most people can understand them. So, not too simple, but they should be at least be understandable to a fairly sophisticated user. I remember my teacher saying that. So your report should be able to be understood by a fairly sophisticated person, not a simple person, but a fairly sophisticated. And so it needs to be understandable to a degree where you have enough information in there that someone who kind of knows accounting or knows statements will know about it, but not too simple to where you're going over what you're not putting in enough details. A target audience with financial reporting should be investors and creditors, because those are the people that are going to be either loaning your money, as in a creditor, or an investor, which is going to be a stakeholder. They're going to buy shares of your company. They own equity. So either people who are giving you debt, or who are giving you equity. So you either owe them money, or you owe them equity, and they actually own your company. And then accessing future cash flows. So cash flows, once again, most important statement. They expect you to have cash coming in to fund payments to either pay down your debt or to pay dividends. So they want to make sure you have future cash flows. Economic resources, just to make sure, should provide information on the assets of the company, liabilities, owner's equity, what have you, so that they know where you stand. And then primary focus on earnings, which is just, are you making money? Are you profitable? And so, and the next, the qualitative characteristics of accounting information. Benefit greater than cost. Very big. Don't do something if it's going to cost more than it benefits. A good example would be if you go and you buy a brand new movie, a Blu-ray movie for $20, and then you just decide, you know what, I don't really want this movie, I'm going to sell it. So you sell it, of course, it's depreciated because it's used, you might get $10. So now, that movie, buying it in the first place, the cost was greater than the benefit. It wasn't very good. So benefit's greater than cost. So like with accounting is you shouldn't pay your accountants more than what they provide. You see how, or you shouldn't buy a building, a brand new building, if it's not going to give you a benefit greater than what the cost was. So an example would be if you owned an RV park and you put in a very expensive, up-to-date playground. How about that? A playground. And you might think, oh, this is a lot of money. It's not going to immediately give me money. But what you got to understand is the benefit might be that people with more children will come and stay at your RV park. Because now you have a great, up-to-date playground that attracts people. So there's where the benefit might be greater than the cost. See how you're seeing? So this is a great benefit greater than cost. Remember that when you purchase something. What are you going to get out of this purchase? Either not now, but along the way. How is it going to help you? And so sometimes it's not always clear. You got to read into it. Relevance. Is it relevant? Which means, does it give feedback? Does it tell you something? Is it predictive value? Does it tell you something that you can predict based off that? And is it timeliness? Is it in time? Is it not too late or is it not too early? That's what it should have. Reliability. Is it verifiable? Can you verify this information? Is it represent faithfulness? Is it honest? Is it trying to do what's best for you? And neutrality. Is it neutral? Does it not take one side or the other? Is it just telling you how it is without sugarcoating it or playing one side or the other? And of course, comparability. Comparability means, can you put it against a benchmark or a standard? Can you look at the industry averages? That's what help you. So you know, okay, this is where we're at with this. Materiality. Is it material enough to make a difference? This is big, and it changes from company to company. McDonald's, I think, their materiality is, $1 million? Anything under $1 million doesn't matter. So they'll round up or down in the millions, I believe. So for me, what's material is even down to, I would say, $1 to $5 is what's material to me. Maybe 5 to 10 actually. But for a bigger company, they don't keep track of the dollars and cents. They're just going by millions. So that's materiality. Is the item large enough to influence your statements? If you make a $1 purchase, if McDonald's has a $1 purchase, that's not material. They can actually almost sweep that under the rug. It doesn't matter. And so that's where it depends on the company. To an individual, we're very different. Some people might go down to the cent that matters. Like, where is the cent going? So yeah. And of course, see, this is all stuff you've pretty much learned before. I'm just going over. And then the next 5 things. measurement. Measurement is important. So there's 5 different measurement styles: historical cost, current replacement cost, fair value, net realizable value, and present value. Or discount. Historical cost is usually land, buildings, equipment. So when you buy something, you leave it at that price always. It's usually the date of acquisition. Current replacement cost would be inventories. What's the value? Has the value declined in price since you bought them? Fair value is financial instruments. So that could be like stocks. Fair value, what is it going for now? Net realizable value is accounts receivable. How much are you actually going to collect on that account? Because the longer someone doesn't pay you, the more likely you're not going to get the money. And then present or discounted value, basically bonds. Let's usually bonds. Okay, and of course there's usually 3 major career fields in financial accounting: public accounting, corporate accounting, and user analyst, banker, and consultant. So public accountants usually do not work for any single business. They're on their own. They usually do audits, reviews. They just maybe taxes sometimes for people, but usually they just do one thing for a company, and they do it for many different people. So they work on they're a separate entity. Now, corporate accountants are accountants that work in a corporation. So they do primarily external reporting and managerial reporting. User, which are like analysis, bankers, and consultants. So sometimes for people out there, anyone viewing, you might not want to be an accountant. This is for, if you want to be a banker, you're going to need some accounting. It's going to help you. And maybe you're you want to be a Wall Street guy, an investor, or a forecaster, that you're going to want to know accounting also. And so, then of course, the importance of personal ethics. I've gone over that, and that's pretty much it. Thank you so much. I hope this intro helps. It's a lot of just what you already know, not anything new. And of course, intermediate accounting, some stuff you already know, but it's going to have some stuff you won't. So this is great for those continuing on, and I hope you enjoyed it. Please like, comment, and subscribe. Anything you do helps me know better and what you need also. And you can ask questions as a comment, and I'll do my best to answer them. And so thank you so much, and I'll see you next time.